Why diversification is secretly robbing you blind. You own 12 funds. You think you're protected. You're not. You're paying 12 different fees to own the same 8 stocks. Here's what nobody shows you. By the end of 2025, the top 10 companies in the S&P 500 accounted for nearly 41% of the entire index, more than double the roughly 19% they held a decade ago. Nvidia alone is about 8% of the index. One company. So when you buy the S&P 500, thinking you own 500 companies equally, you're actually making a concentrated bet on about a dozen names wearing a 500 company costume. The other 488 companies are there. They just barely matter. It gets stranger. Analysts now put the effective number of securities actually driving returns at around 44, the lowest in 35 years. Think about what that means practically. Nearly 90% of the index's companies are contributing almost nothing to where your money actually goes. You own them on paper. You don't really own their upside. Before you say, but those top companies are just better businesses, so this is fine. Partially true. The top 10% of S&P 500 companies by weight generate about 60% of the index's total net income, real earnings power, not just hype. But in Q3 2025, the Magnificent Seven accounted for roughly 31% of the index's entire earnings growth. 7 companies, nearly a third of the engine. If 2 or 3 of them stumble, an antitrust ruling, a bad product cycle, a regulatory crackdown, your 500 stock index fund doesn't behave like 500 stocks. It behaves like a leverage bet on a handful of AI darlings. We've watched this before. At the dot-com peak in 2000, the 10 largest stocks hit what looked like a terrifying record, about 26% of the index. From that peak through 2008, growth stocks fell over 57%, while value stocks barely moved. The market punished concentration hard. Today's number is 41%. We're not near 2000 levels. We blew past them. The people most exposed are the ones who think they're safest because they own the whole market. Now here's where your personal diversified portfolio gets exposed. A study comparing large-cap mutual funds from completely different fund houses, different brands, different managers, different pitch decks, found the average overlap between any two was 45%. Nearly half the holdings, identical. Industry tools generally agree, once 2 funds cross 50% overlap, you're not holding 2 funds. You're holding 1 fund twice, paying 2 sets of fees for 1 set of risk. This isn't a conspiracy, it's arithmetic nobody checks. A real example. Fidelity's Magellan fund under Peter Lynch ran with an active share above 80%, meaning the portfolio looked almost nothing like the index it was benchmarked against. That's how Lynch beat the market by roughly 150% over a decade. He was actually doing something different. Then in 1996, Robert Stansky took over. Active share quietly collapsed to around 30%. The fund started mirroring the S&P 500 almost stock for stock, same weights, while still charging active management fees. The result? Magellan lagged the index by about 1% a year for 10 straight years. Not a dramatic blow-up, just a slow invisible bleed dressed up as professional management. Year after year, fee after fee. Investors had no idea. The fund kept its famous name, the ads kept running. This has a name, closet indexing, or index hugging. A fund that markets itself as actively hunting for winners, while secretly shadowing a benchmark and billing you like it's doing something special. The manager gets downside protection. If the fund looks like the index, it can never badly underperform the index. The investor pays active fees for passive performance. Regulators have caught this at scale. In 2018, the UK's Financial Conduct Authority forced multiple asset managers to issue refunds after their actively managed funds turned out to be expensive index trackers in disguise. Documented enforcement. Actual refunds, not a theory. So why does this keep happening? Because diversification might be the easiest word in all of finance to sell. It sounds careful. It sounds adult. Nobody ever got fired for recommending more of it to a nervous client. Advisors aren't incentivized to sit you down and explain that your 11 funds are basically 1 fund in a trench coat. They're incentivized to keep every line item generating its own fee indefinitely. The complexity isn't a bug, it's the product. Grab 6 different chip bags at the grocery store because you want variety. Then notice later they're all made by the same parent company, same factory, same 3 flavor bases, different packaging. You paid more, you got the illusion of choice. This is your portfolio. Here's an illustrative scenario, not a real case, just the math. Imagine someone with $300,000 spread across 11 funds. A total market fund, a growth fund, an AI innovation fund, a dividend fund, a small cap fund, for balance. On paper it looks responsible. 11 lines on the statement, 11 different fund names. But if half those funds quietly mirror the same mega cap holdings, You're paying fees on duplicated exposure. And when those overlapping stocks move together, and they do, especially during a crash, exactly when the diversification was supposed to protect you, there's nothing there. You find that out at the worst possible moment. True diversification means owning assets that move somewhat independently of each other. Different sectors, different geography, different asset classes entirely. Bonds, real estate, commodities, sitting alongside equities. When stocks drop 30%, you want something in the portfolio that doesn't. Fake diversification means owning the same stocks through different wrappers with different logos, paying multiple sets of fees, and calling it a strategy. There's also a feedback loop, making this worse every year, that nobody talks about. As more money flows passively into index funds, it disproportionately flows to the largest companies, because that's how cap-weighted indexes work. More money in the index means more money automatically buying Apple, Microsoft, Nvidia, regardless of valuation. Bigger gets bigger. Those inflows push prices up, which increases the weighting, which attracts more passive inflows. Nothing about that cycle has anything to do with whether those companies deserve the capital at current prices. It's math feeding on itself, and it ends when it ends. So, what do you actually do? Run an overlap check first. Free portfolio tools will show you, in real percentages, how much of your different funds are secretly identical underneath the branding. Do this before anything else. The number will probably bother you. Count unique holdings, not number of funds. 11 funds holding 40 total unique stocks is not diversification. 3 funds holding 40 genuinely uncorrelated assets is. If you're paying active management fees, find the active share number. Below 40%, and you may be paying Magellan Understansky prices for what is functionally a closet index fund. That information is usually on the fund's fact sheet or Morningstar page. Takes about 2 minutes to look up. Diversify across asset classes, not just fund labels. Equities, bonds, real assets, cash, that's structural. 4 tech-heavy funds with different names is not. Watch the concentration inside the index itself. If your core holding is an S&P 500 fund, you're already carrying meaningful single-stock risk. Know it, and size accordingly. And in almost every case, fewer, broader, cheaper beats more, narrower, expensive. A single total market fund paired with a bond fund will out-diversify a clumsy 12-fund portfolio at a fraction of the cost. Simple portfolios don't generate advisory fees. The industry doesn't want you figuring that out. You weren't wrong to want safety. You were sold the illusion of it. Repackaged 11 different ways, each one with its own fee, none of them actually protecting you from the thing you were afraid of in the first place. So, is this overlap problem A, a genuine blind spot most advisors never bother to check, B, a deliberate fee generation tactic the industry has no incentive to fix, or C, both, with incompetence and incentive pointing in exactly the same profitable direction? Drop your take below, and if you've never run an overlap check on your own portfolio, go do it now. You probably won't love what you find.